Is it better to invest or to trade? A lot of people have heard the saying, time in the market is better than time in the market. And when opinions and decisions have been made, people split this saying into two categories. They split market timing or market timers to traders, and then they split market time or longevity into investors. Wagwan, my name is Demetress Fairman, and in this video we will discuss who are traders, who are investors, what do they do, and ultimately which one is best. Disclaimer time, I am not a financial advisor and I don't give advice. I only share my portfolio. I only share what I learned and my experiences. This channel is just basically an expression for me to share my understandings and share my experiences as I progress through my investment journeys. Also, if you don't hear a lot of noise in the background, and not my fault. Kevin, he look like him resurrect and him down there preach right now. So just bear with the loud noise. And the place hot, so if you don't hear the fan at the background. When we mention traders, these images come to mind.
My name is Jordan Belfort. I made $49 million, which really pissed me off because it was $3 shy of $1 million a week.
Traders generally buy stocks with the intention to sell this stock in a short time frame while retaining as much profit as possible. While investors like myself buy stocks with the intention to hold for a longer time frame for gradual appreciation and for income possibilities, aka dividends. For the average person, these definitions are basically the same. So let's face it, we are both buying stocks with the intent of gaining a profit. So what makes them different? What makes a trader different from an investor? While doing this video and finding a way how to format it so that you guys could understand it properly, I found a video on TD Ameritrade which basically explain it as is. So thank you to TD Ameritrade for posting this video. I highly appreciate it. And if you guys want to watch that video, it will be down in the description. So I could jump into the meat of the matter. Let's jump into the information section of this video. To properly differentiate trading from investing, we have to use three metrics to get this done. These three metrics include the time frame, the activity, and the risk management. The way traders go about time frame is that they seek to enter a stock multiple times, and with each entrance and exit, meaning each buy and sell, with the intent or result of the most profits possible. This results in a shorter time horizon and more frequent buying and selling activity, which is called volatility. Speaking of activity, traders are considered to be charts and graph watchers, being that they look for the perfect entrance and exit on a stock chart, then they have higher trades throughout the day. Trading techniques such as day trading, swing trading, scalping all deal with time periods in the market, with some periods lasting a couple seconds, some lasting a day, a week, a month, and even up to a year. Ultimately, a trader's activity will rely on technical analysis. And this is basically using historical data to analyze a chart to predict the best entrance, which is a buy, and the best exit, which is a sell. Along with the help of technical analysis, traders rely on the use of price targets and stop losses to mitigate their loss to profit possibilities. While trading may have a large profit upside, it also has a large loss downside. Take for example, I have a $100,000 trading account, and I risk a 3% gain to a 1% loss. That 3% gain is $3,000 at the risk of losing $1,000. But if you take a person who has $1,000, for him to get that same $3,000 profit, he would have to have a chance of predicting a 300% stock movement or stock appreciation. Likewise, for him to risk a 300% gain, ultimately his loss would have to be of the same equivalent because he needs that movement, that volatility, in the hopes of getting that 300% gain. Therefore, scenario A is termed less risky than scenario B. But if you disagree with that statement and you have something that you want to teach us, maybe show us a different aspect, something that we're leaving out, then comment down below in the comment section. We're always up to learning new things. Now let's talk about the investors and how these three metrics apply to them. Investors want to experience the general appreciation of a stock and also the possibilities of earning an income, aka a dividend. By wanting this outcome, the only course of action is to stay and play the long game. And it's not uncommon for most investors to hold the stock with no intention of selling because this stock is generating a passive income for their lifestyle. It would be the same as owning a rental property with no intention of selling but rather keeping that property in the family for generational wealth down the years to come. While traders enter a stock by analyzing that stock's price point, investors generally look at the health of a company, and this can be indicated by the earnings report, the balance sheets, the income statements, and the financial reports. An investor's activity is not based on the volume or the high trades or the volatility, but it is rather based on a company's fundamentals. While some investors enter a stock regardless of that stock price, some will enter that stock based on a cheaper analysis, and they generally depict this by using the intrinsic value of that stock. But investors' activity is generally low in the market because their solid intention is to inevitably buy a stock and hold. Risk is taken when picking a stock and not associated with price fluctuations, because for investors that is inevitable. By proper research of the fundamentals of a company, this is when an investor takes their initial risk in investing, because once they do their research, it doesn't matter if the price goes up or down, they forecast for that and they know that that's a part of the investing journey. We're going for the long run to reap as much benefits over a longer period for that stock. In summary, here are the pros and cons. Pros for the investor is that we're not looking for market volatility. We're not looking for price going up and down. We're looking for holding for as long as possible and reaping all the appreciation and income benefits of that stock. For an investor, they also have the effect of compound interest. And if you've seen it in my previous dividend videos, I use this principle to increase my position in a stock. When I get my dividends, I automatically reinvest it into the stock, meaning that that money will build on each other, and then as time goes by, I will increase my dividend because I am just putting back that money into the stock, which increase the interest in return. Third pro is consistency, because we've seen the returns of the stock market over the years. We have seen approximately 8% return each year in the stock market according to the S&P 500. So basically, you are guaranteed an 8% or more return from your stocks if you hold for the long run. And the fourth pro of being an investor is that you can invest confidently because there's a lot of information that helps you in making a proper and wise decision. The cons, on the other hand, of being an investor is that it is slow growth. While some stocks may increase 1000%, those are anomalies and they don't generally happen a lot. But if you catch one, you catch a unicorn and you're lucky. But for the general market, for the average market, you will have slow growth in stocks. So don't look to be a millionaire overnight. Don't look to be a millionaire in 10 years, but just wait for the long game and help preserve your wealth. A second con is that investing is boring. It doesn't give you the thrill of losing your money. It doesn't give you the thrill of gaining 1000% in a day or a minute or a second. It's generally for a long period. It's slow and it's boring, because when you think of investing, the first person to come to your mind is a gray-haired man named Warren Buffett. But if you think about trading, then automatically you think about Ferraris and a fast car. And the third con for investing is that it takes a lot of research, because to know all the ratios, to analyze a stock, to read all those balance sheets and reports, you'd have to do a lot of reading and research. So the research is a lot, but it is worth it because it brings more confidence in you choosing a stock. So let's talk about the trading pros. And one of the greatest pro when it comes to trading is that you get quicker gains. Because once you have more volatility in the market, you are more susceptible to those major increases. So you can even get that 300% increase within a day. You can get that 500% increase within a week. So you have more volatility in the market to maneuver or to plot your entrance and exits to make sure that you get the best profits. A second pro of using trading is that once you build that trading skill and you've mastered that trading skill, you've noticed that I've used the word skill 2 times. So what can you do with a skill? You can make money from a skill, you can monetize a skill, you can teach a skill. So it's something that brings you a benefit because it's quite a lucrative skill. When you think about trading, you don't necessarily have to be doing it from home. A bank could also hire you to be their trader because active investors generally need the best entrance points to go into a stock to hold for long term. So they will need the trader's help right there. The third pro is that I've seen traders who learn how to manage their emotions properly and they don't let a stock dictate how they feel morally. They're just in it for the profits. Now for the cons. With a high risk, there's also a high possibility for a major loss. And with major market volatility, those losses will happen more frequently than it does with an investor. And with seeing those major volatility movements, it leads you to be more stressful because then you will overthink what your decision is and if that decision was the right thing. You may also get addicted to this process. And with those high volatility and high chance of gaining maximum profit, it tends to become addictive. And some people will look on trading as gambling, and then you can see where the problem is right there. You would have people who become addicted to the process and in turn turn it into a gambling game. And finally, when it comes to the cons, is that with all these trading activities and frequent in and out of the market, it generally attracts a higher transaction rate because you're making multiple transactions throughout a trading day. When it comes to choosing if you're a trader or you're an investor, it's as simple as this. If you like buying and selling stock, if you only buy on price movement, if the only thing that you care about a company is its stock price, then my friend, you are a trader. On the other hand, you might be an investor if you like long-term growth, if you like getting paid a dividend or an income, if you're uncomfortable with jumping in and out of the market, then you could consider yourself an investor. As to which is best, I think a hybrid of the two is the ultimate goal. Because let's look at this scenario. If you invest in company A and you know all their fundamentals, you know what company A produces, you know what they've done in the past, you know what they're going to do for the future, you know all their money movements, you know this company inside out, then you would apply the know-how of a technical trader to know the best entrance point or the best buy price of that stock. Then trust me, that's the best outcome possible, because not only will this company be backed by immense research, you can also get this company at a great stock price for the best outcome of appreciation. And that is why big financial institutions like hedge funds use investors and traders, because together they make the best yin and yang. And to me, by having the perfect mixture of both an investor and a trader, you maximize gains, and that's one of the best tools for success. But if you want to invest in the stock market and you don't know what the stock market is, you don't know where to start, you don't know certain jargons, you want a better understanding of the basics, then you can just watch this video right here. I have a stock market for beginners playlist, and yeah, just watch it. Watch it. Me meeting over there.